Hello, everyone. Bill Condon and Matt McGregor here for another podcast. We're going to be talking about the activity on the capital market side and how much demand there is out there, and really kind of review the year in 2019 from a capital markets perspective.
Yeah, you can catch our podcast on Apple Podcast, Google Podcasts, and you can always see us on our website, industrialadvisors.com. Welcome to the show. So, Bill, on cap markets, it seems like we get about 2-3 calls a day. Similar theme. Somebody's got a bunch of money and looking to place product here. How are you feeling about that? I mean, there's so many firms. It seems like so much money out there. Tell us about some of the calls you're getting and what the activity's like.
Yeah, lots of calls to place money here in Seattle. I think every single year Seattle has, and when I say Seattle, I'm talking the overall Puget Sound market, has become increasingly popular for institutional groups and private groups to place money. You look at the market fundamentals and compare it to other markets across the country. Seattle, from an industrial standpoint, is as good as it gets. And certainly that is in line with the calls that we're getting from a variety of groups looking to place capital in our market.
That's right.
And aggressive capital in our market.
Yeah, it seems to be getting a little more challenging as, this obviously we've transitioned over to, I don't know what the total percentage is, but certainly it's an institutional market, and every year there's less and less user sales, local investor sales, as those guys have been selling off since like 2004. Mm-hmm. And you've had year over year of those type of transactions, and those guys are disappearing, and the institutions are holding longer. So it's harder and harder to place money, correct?
It absolutely is, and that's a really good point. I mean, we're selling right now some institutional deals, but we're also selling for a user 2 smaller buildings, a 45,000 footer and a 25,000 footer, and they're being bought by an institution, right? So even the smaller buildings are being gobbled up by the institutional groups, and they're competing with users on pricing, and in fact they're beating users from a pricing standpoint. So certainly it's become more and more of an institutional market, and private sellers are selling because they believe that pricing's good enough, and
right.
And we're at an all-time high, right? So certainly that has driven some of the sales that have taken place, along with on the user side, that the excise tax increase that has driven a couple sales as well.
That's right. And let's talk about who's hot out there, and what markets are hot. By sales volume over the last 24 months, Centerpoint has placed the most at $150 million. Certainly they've been active.
Yeah, that big buy in Seattle was a great purchase for them. And yeah, they continue to buy deals in close-in markets and do a good job of tracking and closing on those deals.
Yeah, it looks like they've done 4 transactions, and this is deals over $5 million on the industrial side in the greater Seattle market here. So Centerpoint's done 4 deals. Market leader by number of transactions is Lift Partners.
Yeah.
With 5. And then you've got TA and Clarion both with 3, Prologis and 11 others with 2 transactions, and then you have a whole ton of people with 1.
And then a bunch of people that would like to have had some tallies in purchases that
That's
just
right.
haven't been able to get in. Yeah.
Yeah, to our point earlier, it's endless calls with, hey, I got $1 billion, need a place in Seattle.
Right.
Oh, really?
Yeah.
Okay. And then going back to the total sales volume by entity, Duke right under Centerpoint with $147 million and change, and then TA, Clarion, Prologis, and a few others above $100 million in total placements. So pretty good activity. Certainly we've had, over the last 36 months, huge volumes. Last year, 2008, there was $1.5 billion traded in that year of industrial assets. So a record by far. Our average is about $650 million. So that was over 2 times our average. But then this year, I mean, it's been a bit of a struggle. We're at about $450 million year to date, and we've only got a few months left, knowing that fourth quarters are typically hot.
Yeah, I think we're going to see, and we have about, you call it $160 million ourselves that'll close before the end of the year. So I think that certainly the third and fourth quarter are going to be big from a sales volume standpoint. So I think we'll end up where we typically do.
But way off last year.
Yeah, way off last year. We're not going to do that. But I think from a historical standpoint, we'll be where we typically are.
Agreed.
The other thing I think to look at from a capital markets standpoint is there are certainly a number of groups that are out there and trying to place capital. The aggression continues to get stronger and stronger from a cap rate standpoint, from a price per pound standpoint. Obviously, a lot of that has to do with rent growth. But every time a deal trades, a new record gets set on a price per square foot, right? So it's becoming the new norm.
Yeah, we've seen a lot of caps in the upper 3 range over the last 6-7 months.
Yeah, and I think that just, again, speaks to the demand to be here.
That's right. And then pounds per square foot, we're starting to get used to the $200 plus number, right? I remember the first couple conversations, people are like, that's just not happening, right? That's crazy.
Yeah.
But now, on several of the projects we're selling and have sold, met and exceeded $200 a foot. How are conversations with buyers that you've had related with pounds per square foot?
Yeah, it's becoming the new norm and buyers get it. And I think that the buyers that are educated on our market know that number is going to continue to get pushed, right? So from a rental growth standpoint, they're bullish and should be. The other part of it is land, right? Look at what land has done in the past couple of years, right? Land's doubled. And
at least.
Yeah. So, if you're looking at, $40 dirt, right, then certainly $200 a foot makes sense.
Yeah. To your point on that, I agree with you. It's probably in many cases doubled in the last year. But if you back up and look at some of the stuff that we're selling and others are selling right now, even at $200 a foot, when you look at it, as we talk about in development, it takes, 3, 4, 5 years to entitle these sites before they deliver. So these sites that were probably bought at $10, $11, $12 today would trade at, $40, $45 to build. So when you look at the replacement value, all of a sudden for the price you're buying it, let's just say it's a 4 cap at $200 a foot, you can't find the land, build it with your carry costs at $45 a foot, lease it up for that price. You can't do it. So why not buy it fully leased?
Right. And if you're going to be here, you have to pay up. And when you look at the last couple of years, everybody that's bought, that's set a new record on price, and people say, oh, wow, that was an aggressive buy, they all look pretty good right now, right?
That's right.
So I think that when you look at from a fundamental standpoint, those buyers that are buying this year, those buyers that are buying next year will all look good, a couple years down the road.
That's right. Let's talk about how to buy it in Seattle. We're a really interesting market. You and I started tracking how deals are traded several years ago because we saw a trend of so many off-market transactions that it was crazy. That we'll just tell the listeners, it was for about 3 years we were tracking it. It was about 61% of all transactions, again, above 5 million were traded off market. We've seen that now drop to 51%. Why do you think that is? Why do you think people trade deals off market?
Yeah, I think that is a reflection of that being private buyers who have been educated on the market, that understand, where pricing has gone and have always kind of had a number maybe in their head. Hey, I'm a seller at this number, and buyers are hitting it, right? And so they're taking some chips off the table and understanding that, they're getting good value for a building, and maybe it's time for them to, go place that capital elsewhere. I do think that number is going to go down from an off-market standpoint, as we become more and more institutional in our market. That number will decrease from a percentage standpoint of deals off-market. Yeah, and it will continue to as well. Yeah,
and mostly because most people that do that, not to say institutions don't trade off-market, but typically they don't. And I would say certainly the majority of these off-market transactions are the smaller deals. Right. You're not seeing a $100 million asset trade off market.
Yeah, they're the $5 to $8 million deals. That.
But it's the bulk of the inventory.
Sure. Yeah, from our market standpoint, yeah.
And I think that percentage is going down because there's less and less local guys, to our point earlier, that it's more of an institutionalized market. And every year you're going to have less local buyers to sell inventory.
Yeah. Automatic Products is a good example of that, right?
That's right.
Trading, a local owner runs a business, trading to 2 of his buildings to an institution.
Yeah, it's always interesting when people come here to say, hey, oh, gosh, Matt and Bill, how do I buy? What do I buy? And we say, if you're going to wait, on average, we only have about 24 transactions a year above 5 million. So if you look at it and say 50 to 60% of the deals have been off market, you don't have a lot of at-bats if you're only buying on market. So the best strategy is, certainly chase some of those on market deals, but you better throw an oar in the water on off market deals and try both product types. Otherwise, you're really going to be limited to those very aggressive fully marketed deals.
Yeah, and then it's interesting because even on the fully marketed ones, people have to kick themselves if they miss a deal by $200,000-$300,000, right? You look back and say, I wish I would have bought it, right? So it's important to, if you really want to be in this market, you got to be all in and get aggressive, and just know that, be bullish on the fact that rents are going to continue to increase, and your initial returns might be lower than anticipated, but they'll get to where you want them to be.
That's right. Transitioning to what markets are hot, I was surprised when we started looking at the statistics to know that Seattle Seattle, the close-in market, 41 million square foot submarket, had the most transactions over the last 12 months with 10. Why do you think that is?
I think you look at that market, and Lyft has bought a couple deals, Torino's bought a couple deals, Centerpoint, of course, and really there's, from a land standpoint, very few opportunities to go buy. So you look at South Seattle, great from a fundamental standpoint, and as we continue kind of the last mile trend in our market, being close in is important. And you look at where rents are at, they're going to continue to go up in that market just because there's very few sites where you can actually build new product on.
That's right. Just out of curiosity, talking about hot markets, if you had, say, $25 million and you had opportunities in all the markets to buy, what would you buy? What would you look for and why?
I would buy in the North Valley and Tukwila, Renton, Kent, Auburn, and I'd look for 100 to 200,000 square foot building that I could demise, because that's the bread and butter
small deals
of our market. Yeah. And I think the North Valley's got the most upside from a rental growth standpoint.
For sure.
Compared, when you look at what South Seattle's doing, the
Renton,
proximity.
Tukwila.
Yeah. I mean, so I'm always bullish that tenant activity is going to be strong in the Valley.
That's right.
What would you buy?
I would definitely chase, to your point, the North Valley, because I think that's the biggest rent growth. If you can buy vacancy there or buy near-term rollover, certainly I would be all over that, because I think you're going to see the biggest rent growth. But one value component that I think is out there is, if you can buy it and it's available, buy shell construction forwards, pre-commits. And the reason why I say that is, again, based on the land costs. A lot of these developers that are building these right now are, they take 3-4 years to entitle the land. They probably bought it for $11. If you can go buy a shell for, $160 sounds like a lot, right? But if that's fully stabilized, it's over $200 a foot. So you've got a lot of lift in that. So if you can run around and buy some shells, you can't build them for what you're going to pay for them. So that's where I would buy, because that's going to be your biggest value component, in my opinion. Yeah,
and you also have the construction period to let rents continue to increase.
Yeah,
I think you're a vacant shell. You're closer. You're 180 a foot.
You
right?
could be.
Yeah, and to stabilize, you might be 220 a foot, right? So depending on where you're at. I would.
I just think you got lift there.
A lot of lift, and the lease up risk is nominal, right? Because it's going to lease if you're in the right market.
That's right.
Tacoma north, through Seattle, you're going to lease up.
That's right. In wrapping up capital markets, I think, again, we've got a very, very healthy market. I think it's challenging to buy here. To our point, I think you got to throw both oars in the water. By the end of the year, probably hit around $700 million, which is about half of what we did last year, but on par with a normal year. You think any other records are set this year? Where do you see that?
I think that you're going to see some aggressive trades that will happen prior to the end of the year from a cap rate standpoint in some good markets. I think you'll look at that and say, okay, that was an aggressive buy. But then when we look at that a year from now, we'll look back and say that was a great buy. Right?
Yeah, that's right.
So I think we're going to close out the year strong from a capital market standpoint with good volume in the fourth quarter.
Mostly because of that 2% excise tax that kicks in.
Yeah. So that has caused some private groups to hit the market and try and get it in this year.
Yeah.
We have 3 or 4 sales like that. But I think that we are going to have a healthy close to this year and continued demand going into 2020 from a cap rate standpoint, rent growth standpoint, and just demand standpoint from institutions.
That's right. Well, thanks for listening to our show today. Get more information on industrialadvisors.com. And as always, you can catch us on Apple and Google Podcasts. Thanks a lot.